Something has shifted beneath the surface of our financial system, and it's important that we examine it clearly, without panic and without denial. Over the past several weeks, observers who have spent decades studying markets and monetary policy have begun making increasingly direct statements about what they see ahead. Not predictions dressed as certainties, but assessments of probability based on observable patterns. Some of these voices have specifically highlighted precious metals, silver in particular, as reflecting a deeper truth about currency erosion, inflation expectations, and central bank behavior that the mainstream financial conversation is still reluctant to acknowledge. This is not a call to action. This is an invitation to understand. If you hold silver or any alternative asset meant to preserve wealth during uncertain periods, this moment carries real significance. If you do not, but you've wondered whether you should, the conversation we're about to have may clarify your thinking. And if you've never considered these questions at all, what you're about to hear will help you understand why some disciplined investors are moving their capital in ways that might seem puzzling to those still anchored in conventional assumptions. The crisis isn't coming. In many measurable ways, it's already here. What we're experiencing now is not the beginning. It's a phase that has been unfolding for years and only now becoming visible to those paying attention. Let's examine what has actually changed, why the implications are being widely misunderstood, and how you should think about your own financial position in this environment. For the better part of a decade, global monetary authorities pursued a strategy that was, by historical standards, extraordinarily aggressive. Interest rates were pushed to zero. Central banks purchased trillions of dollars in bonds and other assets. Money supply expanded at rates rarely seen outside of wartime. The stated purpose was to stimulate economic activity and prevent deflation. The mechanism was simple. By making money cheap and abundant, policymakers hoped to encourage borrowing, spending, and investment. For a time, this strategy appeared successful. Asset prices rose, employment improved, the illusion of recovery took hold, but there was an underlying cost that most people either didn't understand or chose to ignore. When you create money rapidly and continuously, you don't make the economy richer. You redistribute wealth, you debase the purchasing power of the currency itself, you encourage excessive debt accumulation, and you distort the price signals that markets depend on to allocate capital efficiently. What we're seeing now is the maturation of those distortions. Inflation, which officials assured us was temporary, has proven stubbornly persistent. Labor costs have risen substantially. The price of energy has become volatile and elevated. The cost of housing in many regions has moved beyond the reach of ordinary workers. Basic goods cost measurably more than they did just a few years ago. This is not a coincidence. This is not a supply chain problem that will resolve itself. This is the predictable result of sustained monetary expansion, meeting a real economy with finite resources and finite productive capacity. Central banks have responded by raising interest rates, a necessary correction, but one that creates new problems, even as it attempts to solve old ones. As rates rise, the cost of servicing existing debt increases. Governments that have spent years borrowing at near zero rates now face refinancing at much higher costs. Corporations that made capital investments based on cheap money find their projects less profitable. Individuals with variable rate debt or coming mortgage renewals face immediate pressure on their household finances. This is the mechanism that transforms monetary policy from stimulus into restriction. The lag is the only reason it isn't felt immediately. What has changed is this. We have reached the point where the consequences of the prior expansion are becoming undeniable. The question is no longer whether excess monetary creation will have real effects. The question is only how severe those effects will be and how long they will persist. A secondary but crucial change is occurring in how global actors are responding to currency pressures and geopolitical tension. The United States dollar has long served as the world's reserve currency, the medium in which global trade is conducted, in which governments hold their foreign reserves, in which international debts are denominated. This role is extraordinarily valuable. It allows the United States to borrow in its own currency, to finance deficits that would otherwise be unsustainable, and to exercise significant economic influence globally. But that privilege depends on confidence. It depends on the belief that the dollar will hold its value, that the United States will meet its obligations, and that holding dollars or dollar-denominated assets is a reliable store of value. When you expand the money supply dramatically, you undermine that confidence. When you incur large fiscal deficits year after year, you raise questions about sustainability. When the world watches these trends, some actors, particularly major nations with their own economic and political interests, begin considering alternatives. We are already seeing this in action. Trade agreements that bypass the dollar, central banks diversifying their reserves away from dollar assets, countries establishing bilateral payment arrangements that reduce reliance on dollar-based settlement systems. This is not something that will happen. It's something that is happening, incrementally but persistently. The combination of these forces, monetary debasement creating inflation, fiscal strain creating questions about creditworthiness, Geopolitical fragmentation, reducing demand for dollar reserves, creates a particular kind of financial environment. In such environments, assets that cannot be devalued by central bank policy, that cannot be defaulted upon, and that have been valued as insurance for centuries, tend to move upward. This is not speculation. This is not hype. This is historical pattern. The mainstream financial conversation continues to operate on an outdated framework. The consensus view, promoted by most institutional advisors, reflected in most financial media, embedded in most retirement planning models, assumes that the current monetary regime is stable and sustainable. It assumes that central banks have inflation under control. It assumes that government debt is not a meaningful constraint on policy. It assumes that the dollar will maintain its role as the world's unquestioned reserve currency. These are not wild assumptions. They reflect the experience of the past 40 years. For 4 decades, inflation was generally contained. Central banks did have credibility. The dollar was, in fact, the unquestioned global medium of exchange. But stability in one regime does not guarantee stability in the next, and the regime has changed. Most investors don't realize this because they've never lived through a meaningful dollar devaluation or a period of sustained inflation or a loss of confidence in government creditworthiness. Their entire investment experience is colored by the assumption that these things don't happen, that our institutions are too powerful, too disciplined, too self-interested in stability to allow such outcomes. This is not hubris on their part. It's simply the experience of living within one particular historical period. But history is longer than a single generation. And pattern recognition, understanding what happened in previous eras when similar conditions arose, is essential for navigating what comes next. When currencies are debased, historically, people who own real assets, land, commodities, productive capacity, tend to preserve their wealth. Those whose wealth is stored entirely in cash or fixed income instruments denominated in that debasing currency tend to suffer erosion. This is not a moral judgment. It's not a condemnation of central bankers or government officials. It's simply an observation of what happens when the purchasing power of money is deliberately reduced. Another source of misunderstanding is the confusion between nominal and real returns. If you hold a bond paying 5% interest, you might feel secure. But if inflation is running at 4%, your real return, the actual increase in purchasing power, is only 1%. If inflation accelerates to 6%, your real return becomes negative. You're getting poorer, even as your nominal account balance grows. This is devastating for retirees, for savers, for anyone whose wealth is held in cash or traditional fixed income instruments. It's why so many people who did exactly what financial advisors told them to do, save diligently, live modestly, build a nest egg in bonds and savings accounts, are finding themselves in financial stress as their purchasing power erodes. The third misunderstanding concerns the nature of risk itself. For decades, the prevailing wisdom has been that stocks represent risk and bonds represent safety, that diversification into fixed income instruments reduces overall portfolio risk. This framework makes sense in an environment of stable currency, stable government finances, and low inflation expectations. But it becomes dangerously inverted when inflation is present, when currency debasement is occurring, and when government debt is reaching unsustainable levels. In such an environment, the real risk is not volatility, short-term price fluctuations that you can ride out if you have time and discipline. The real risk is permanent loss of purchasing power. The real risk is holding assets that are denominated in a currency that is losing value. Traditional fixed income instruments, which were supposed to be the safe part of your portfolio, become the dangerous part. And assets that are hard, scarce, and cannot be created by central bank policy, assets that have historically served as inflation hedges, become, in a very real sense, the conservative choice. Most advisors have not made this mental adjustment. Most investors have not either. This is why there is still so much skepticism about alternative assets, so much dismissal of precious metals as relics of a bygone era, so much confidence that it will be different this time. It usually isn't. A fourth misunderstanding relates to the timeline. When analysts speak of currency erosion or inflation pressures or government debt concerns, investors often hear a prediction that these things will explode immediately. When they don't, when markets continue to function, when banks don't fail, when life seemingly goes on, they conclude that the warning was wrong. But this is a misreading of the warning. Systemic changes happen incrementally, not explosively. The purchasing power of a currency doesn't vanish overnight. Confidence in institutions doesn't evaporate in a single moment. What happens instead is a gradual process of erosion, of shifting expectations, of slow migration of capital toward alternatives. If you look at historical examples of currency devaluation or inflation regimes, you see this pattern consistently. From the 1970s in the United States to more recent examples in other countries, the process is not a cliff. It's a slope. And those who wait until the slope becomes obvious often find that much of the adjustment has already occurred. This is why observers who understand these dynamics have been gradually increasing their allocation to alternative assets. Not all at once, not dramatically, but persistently, as a hedge against a regime change that may take years to fully play out. By the time it becomes obvious to the mainstream financial community, the opportunity, the period in which you can acquire these assets before they become universally recognized as necessary, may be substantially past. Let's put this in historical perspective, because history is the only laboratory we have for understanding how financial systems behave under stress. In the 1970s, the United States experienced a period of persistent inflation. The causes are debated, but the conditions were similar to today in some respects. Rapid monetary expansion, fiscal deficits, geopolitical shocks that disrupted commodity supplies, and a loss of confidence in currency management. The inflation wasn't caused by any single factor. It was the convergence of multiple pressures, wage expectations rising as workers demanded compensation for previous inflation, corporations raising prices because they could, governments running deficits because the political will to cut spending was absent, and the Federal Reserve failing to act decisively enough until circumstances forced action. During that period, people who owned gold and silver, assets that were at the time widely dismissed as barbarous relics, unnecessary for the modern investor, preserved and actually grew their wealth in real terms. Those whose entire portfolio was in fixed income instruments watched their purchasing power erode steadily. It's worth noting that the traditional warnings about inflation were issued for years before things got genuinely bad. The adjustments by sophisticated investors began long before the crisis became undeniable. And when conventional investors finally decided to move, they did so at prices significantly higher than they would have encountered a few years earlier. The recovery, when it came, was extraordinary. Paul Volcker, appointed Federal Reserve Chairman, did what was necessary, raised interest rates to truly restrictive levels, endured a recession, and broke the inflation psychology. But this required accepting years of economic pain, high unemployment, bankruptcies, distress. Few politicians would accept such medicine today. Our system is far more hostile to that kind of discipline. This makes a clean resolution less likely and a longer, slower process of adjustment more probable. In other countries and other eras, the pattern has been even more severe. When monetary authorities lose control of inflation, or when confidence in a currency collapses, the adjustment is often not gradual. It's abrupt. The Weimar Republic, Zimbabwe, Venezuela, Argentina. These are extreme examples, and the situations that created them differed in important ways from the current U.S. situation. We're not suggesting anything that's severe, but they do illustrate an important point. The mechanisms that preserve the value of a currency are not automatic. They depend on discipline, credibility, and political will. When those are absent, devaluation happens faster than conventional investors expect. We're not predicting Weimar, but we are observing that the United States has substantially eroded the conditions that protected the dollar for 4 decades. Looking more broadly at market cycles, we can observe patterns that appear again and again. When a period of financial excess, characterized by rapid credit growth, declining lending standards, and inflated asset prices, finally reaches its limit, a reallocation occurs. Capital that was flowing into risk assets begins flowing toward safety. Yields on risky assets rise because investors demand compensation for the uncertainty. Asset prices that expanded dramatically during the boom contract substantially during the correction. Within this reallocation, certain assets historically function as a rotation destination. When confidence in one asset class or one system declines, capital rotates toward assets that are perceived as more fundamental, more durable, less dependent on continued confidence in institutions or creditworthiness. Precious metals fill that role. They have for centuries, not because they have inherent productive value. A share of stock or a rental property generates cash flow, while precious metals generate none, but because they serve as a store of value when other stores of value are in question. This is not irrational. It's a rational response to regime change. If you already hold silver or gold or other alternative assets meant to serve as insurance against monetary debasement, this moment requires clarity and discipline. First, understand that holding insurance is not a speculative bet. Insurance is not supposed to be your highest returning asset. Insurance is supposed to protect you if a particular risk materializes. If that risk doesn't materialize, the insurance provides no return, and that's exactly as intended. For decades, the risk that precious metals insurance is designed to protect against, sustained inflation, currency debasement, loss of confidence in monetary institutions, did not materialize. So holdings in these assets provided no return, and sometimes provided negative returns. It was easy, in that environment, to question whether the insurance was necessary. But insurance is most valuable when you're about to need it, and the probability that you're about to need it has risen substantially. If you hold these assets, don't feel compelled to act on that holding based on short-term price movements. Silver's price will fluctuate. It will have periods of strength and periods of weakness. These movements are normal. They're noise relative to the longer-term structural forces at work. What matters is that you own a prudent allocation, not an extreme allocation, but a meaningful position that represents insurance against the scenario we've described. How you acquired it matters less than that you own it at a cost basis you can accept. For those who acquired these assets at much higher prices and have watched them underperform for years, this is a moment of potential validation. But it's also a moment to be disciplined and not overextend. The temptation in such moments is to leverage up, to borrow, to buy more, to try to capture upside that you may have missed. Resist this temptation entirely. Insurance that you achieve by leveraging yourself is not insurance. It's a speculation that you cannot afford to lose. If circumstances change, if the expected shift doesn't materialize as quickly as you hope, you'll be forced to sell at exactly the worst time, at losses that could damage your overall financial position. Instead, if you hold these assets and believe that the structural forces we've described are real, you might consider gradually adding to your position at a modest pace, not feverishly, not based on short-term price movements, but calmly as prices fluctuate, by adding to your insurance position at rates that are sustainable and that won't leave you financially exposed if circumstances shift. For those who hold a very large proportion of their net worth in these assets, this might be a moment to reconsider diversification. If precious metals have become 50% or more of your portfolio, not because you carefully planned it, but because they've appreciated, you might consider taking some profits and moving capital into other diversified assets. This isn't because we've lost conviction in the thesis. It's because concentration is itself a risk, and prudent risk management means ensuring that no single asset, however well-reasoned your thesis, can create catastrophic outcomes if your assumptions prove wrong. The broader principle is this: you own these assets because you believe in their fundamental role as monetary insurance. Treat them that way. Don't day trade them. Don't obsess over weekly price movements. Don't let volatility induce you into reactive behavior. Just as you wouldn't sell your homeowner's insurance because the insurance company had a down quarter, you shouldn't sell your precious metals insurance because the price dropped 10%. Conversely, don't assume that this moment or this quarter or even this year will be some magical turning point where everything changes and you'll look genius for holding these assets. Markets are more complicated than that. Surprises happen in both directions. What you can reasonably expect is that over time, as the structural forces we've described continue to unfold, as inflation remains sticky, as debt pressures increase, as confidence in institutions shifts, the value of this insurance will be validated. In the meantime, you hold the position. You don't panic sell. You don't leverage up. You stay disciplined. If you don't currently hold precious metals or other alternative assets, but you've heard warnings about currency debasement and government debt, the question naturally arises, should you? Let's be clear about what we're not saying. We're not saying that gold and silver will skyrocket in value. We're not saying that prices will necessarily go up significantly from here. We're not saying that adding these assets to your portfolio will make you rich. Well, what we're saying is that the probability of a significant shift in how investors think about these assets has risen. That shift, if it occurs, could be reflected in higher prices. But that price movement is not guaranteed, and it may take longer to materialize than a year, 2 years, or even 5 years. What we are saying is that the case for owning a modest allocation, 5 to 10% of your portfolio, by most conventional risk management standards, has become stronger. The case rests on a few straightforward observations. First, the probability of sustained inflation, or of currency devaluation, is higher than it has been in 4 decades. This is not certain. Central banks may still manage to engineer a soft landing, where inflation moderates without severe recession. But the probability of that outcome is diminishing, and the probability of a different outcome, where inflation remains elevated, is rising. In such an environment, holding some allocation to assets that historically preserve value during inflation is prudent. This is particularly true for retirees, or those approaching retirement who cannot afford significant erosion of purchasing power. Second, the price of precious metals has not moved proportionally to the monetary expansion and fiscal deficits of the past decade. By many historical metrics, they remain relatively affordable. This suggests that if the thesis is correct, and if broader investor recognition of that thesis grows, there is room for substantial appreciation. But again, this is not a guarantee. Markets can remain irrational longer than expected. Price doesn't always follow fundamentals in a timely way. Third, for many investors, these assets are not particularly correlated with other holdings. Your stock portfolio will move based on corporate earnings, interest rate expectations, and economic growth. Your real estate holdings will move based on rental demand and construction costs. Your precious metals holdings will move based on inflation expectations, currency movements, and monetary policy. This lack of correlation is not worthless. It means that adding a meaningful allocation to precious metals can actually reduce your overall portfolio risk, not by avoiding volatility, but by ensuring that no single outcome causes your entire portfolio to move in the same direction. If you're considering adding precious metals to your portfolio, do it thoughtfully. Start with an understanding of what you're doing. You're not speculating. You're not trying to time the market. You're adding insurance against a particular outcome, sustained inflation or currency debasement. Because that's your thesis, don't let short-term prices dissuade you. If prices are lower, that's an advantage. It means you can buy insurance at a lower cost. If prices are higher, you might consider waiting for a pullback or buying more gradually. Avoid any mechanism that involves leverage or debt. If you're going to own precious metals, own them with cash. Own them in a form you can actually touch. Physical metal, not complicated derivatives or leveraged ETFs. The value of insurance is that it's there when you need it. Leverage or complex financial structures can undermine that value if circumstances shift. Consider the form in which you hold these assets. Physical bullion is the simplest and most direct. ETFs and mining stocks offer different risk-return profiles and different advantages, but they're not the same as holding actual metal. There's nothing wrong with diversifying among different ways to gain exposure, but understand what you're diversifying into. The amount you hold should fit your overall financial situation. If you're still paying off high-interest debt, building an emergency fund, or dealing with other financial pressures, precious metals should wait. These assets are for people whose basic financial position is already solid. If your financial position is solid and you're genuinely concerned about the thesis we've outlined, that currency debasement and inflation are likely to remain significant concerns for years to come, then holding 5 to 10% of your portfolio in precious metals is a reasonable expression of that concern. Don't expect quick returns. Don't check the price daily. Don't let online commentary push you toward overconfidence or toward abandoning the position. Just own it. Let time and circumstance reveal whether the thesis was correct. Let's be explicit about the mistakes that otherwise intelligent people make when they encounter this kind of analysis. The first mistake is emotional reaction. When you first understand the scope of the monetary expansion, the scale of the government debt, and the potential consequences of continuing current policy, it's easy to feel alarmed. That alarm can translate into rushed action, buying heavily without a plan, without understanding what you're doing, without a clear thesis. Don't do this. The thesis we've presented could be correct, but it could also be wrong. Central banks could find new ways to manage the situation. Growth could accelerate, making debt more manageable. Geopolitical circumstances could shift. The future is not written. If you act emotionally from a place of fear, you're likely to make decisions that you'll regret. You'll allocate too much capital. You'll buy at the worst times. You'll sell when circumstances shift and you lose confidence. Instead, if you decide to act on this analysis, do it methodically and over time. Make the decision once, carefully. Then execute gradually, without emotion, regardless of whether prices go up or down. The second mistake is following online noise and social media hype. There are countless voices online promoting precious metals, promoting cryptocurrency, promoting all manner of alternative assets. Some are driven by genuine belief in the thesis. Others are driven by financial incentives. They profit when prices go up, so they promote heavily. You have no way of distinguishing between these motivations from behind a screen. The worst mistake is giving them control over your decision-making. If you're going to own precious metals, own them because you've reasoned through the thesis and decided it makes sense for your financial situation. Not because some personality on YouTube convinced you, not because a community of online traders is excited about it, not because you saw a dramatic prediction that resonated with you emotionally. The third mistake is over-leveraging. This deserves its own emphasis because it's so destructive and it's so tempting. When you believe in a thesis, when you think you understand something that most other people have missed, the natural instinct is to bet heavily on it, to borrow money to buy more, to use leverage to amplify your returns. This is how fortunes are lost. Leverage is a tool that amplifies both gains and losses. If you're right, leverage makes you wealthy. If you're wrong, or if you're right, but the market takes longer to reflect that than you expected, leverage can wipe you out. Even if the thesis is correct, timing can be uncertain. You might be right that precious metals are undervalued, but that realization might take a decade to manifest. If you've borrowed money against your house to buy silver and 5 years in, you need that equity for an emergency, you're forced to sell. Never borrow to buy insurance, ever. The fourth mistake is allowing this thesis to override all other prudent financial management. You should own these assets as part of a diversified approach. You should still have emergency savings. You should still be paying off high interest debt. You should still be thinking about diversification across asset classes. This thesis is one part of a prudent financial strategy, not the entire strategy. The fifth mistake is expecting prediction from analysis that provides probability. When we say that the probability of sustained inflation is higher or that currency debasement is likely, we're not predicting with certainty. We're assessing probability. Probability is not prediction. Even highly probable outcomes sometimes don't occur. Even unlikely outcomes sometimes do. Don't invest based on certainty about what will happen. Invest based on probability of what might happen and position yourself accordingly. Yeah, the insurance might never pay out. That's okay. Insurance that never pays out is still worthwhile because you didn't need it. The sixth mistake is becoming ideological about it. This is perhaps the most subtle trap. It's easy, once you've adopted a thesis, to become attached to it, to start seeing all evidence as confirming your view, to dismiss contradictory evidence as manipulation or denial by those who don't understand. Avoid this. Stay genuinely open to being wrong. If circumstances change, if the analysis shifts, be willing to adjust your position. The ideal investor is not the one who is right all the time. It's the one who is right more often than wrong, and who adjusts course when evidence suggests a change is needed. Let's return to where we started and think about what all of this actually means for you as an investor and as a person trying to manage your financial future responsibly. The reality is that the financial system is in a state of transition. The monetary regime that prevailed for 4 decades is showing signs of strain. The assumptions that supported the conventional financial wisdom of that era, that currencies are stable, that inflation is easily controlled, that government debt is not a meaningful constraint, are becoming less reliable. This is not necessarily a cause for panic. Systems in transition create both risks and opportunities. Those who understand the transition early can position themselves advantageously. Those who refuse to acknowledge the transition may find themselves unprepared. What should you do with this information? First, stay informed. Not obsessively, not by checking financial news constantly and allowing short-term fluctuations to drive your emotions, but genuinely informed. Read broadly. Understand the forces at work, the monetary policy decisions being made, the fiscal situations of governments, the geopolitical shifts occurring. Form your own judgments. Second, if the thesis we've presented resonates with you, if you look at the monetary expansion, the debt levels, the inflation dynamics, and you find yourself persuaded that a meaningful shift in financial conditions is likely, then consider positioning yourself accordingly. Not dramatically, not emotionally, but thoughtfully and gradually. Third, focus on what you can control. You cannot control what central banks do. You cannot control geopolitical events. You cannot control short-term market movements. You can control how much you save. You can control how you allocate your savings. You can control whether you stay disciplined when volatility occurs. Fourth, extend your time horizon. Most people think like traders, focused on the next quarter or the next year. But genuine wealth building happens over decades. If you're correct about the fundamental forces at work, that correctness will be validated over 5 or 10 or 20 years. Fifth, remember that financial preparation is about more than just asset allocation. Yes, it matters where your money is invested, but it also matters that you're not over-leveraged, that you have an emergency fund, that you have diversified skills and income streams, that you're not dependent on a single employer or single outcome. The broader principle of resilience matters more than the specific allocation of your portfolio. Sixth, don't let this thesis become an excuse for inaction on other important financial matters. Some people, when confronted with the complexity of macroeconomic analysis, become paralyzed. They don't invest at all because they're overwhelmed by the questions about what might happen. That's the opposite of the intended message. The message is, understand the forces at work, take reasonable steps to position yourself appropriately, and then go about your life. Build your career, contribute to your retirement accounts, spend time on things that matter to you. Financial preparation is a background activity, not your entire life. Seventh, cultivate genuine confidence rather than certainty. Genuine confidence comes from understanding. You understand the historical patterns. You understand the mechanisms of monetary debasement. You understand how previous eras have managed similar transitions. This understanding allows you to act decisively without being certain. Certainty is the province of extremists and those who don't understand the complexity of the world. Confidence, rooted in understanding, is the province of mature investors. Something has changed in the financial landscape. The monetary expansion that supported asset prices for a decade has been reversed. The inflation that was supposed to be temporary has proven sticky. The confidence in institutions that was taken for granted is slowly being questioned. These changes mean that assets which were out of favor, precious metals, assets valued for their scarcity rather than their productivity, are becoming more relevant. But this shift won't happen overnight. It won't be dramatic. It won't be obvious until it's already substantially reflected in prices. Your job, if you choose to act on this analysis, is not to predict the exact timing or the precise magnitude of the shift. Your job is to recognize the direction of the shift, to understand what it means, and to position yourself to benefit from it rather than be harmed by it. This requires patience. It requires discipline. It requires the ability to stay calm while others panic, and to take measured action while others are paralyzed by inaction. It requires thinking like a true investor rather than like a trader. It requires focusing on what you can control rather than obsessing over what you cannot. The good news, and this is genuinely important, is that this is all completely within your power. You can educate yourself about these forces. You can think clearly about what they mean for your financial position. You can position yourself thoughtfully. You can stay disciplined through cycles of volatility. You can extend your time horizon. You can diversify your risk. You can build resilience. None of this requires you to be a genius. None of this requires you to predict the future perfectly. None of this requires you to get rich quickly. What it requires is clarity, patience, discipline, and a genuine commitment to understanding the world as it actually is rather than as you wish it to be. If you can provide those things, you'll be fine, more than fine. You'll be in a position to weather the transitions ahead and potentially to thrive within them. The system is changing. Have the wisdom to change with it, the discipline to do so thoughtfully, and the confidence that comes from understanding rather than guessing. That's how you thrive in uncertain times. Thank you for your attention. Stay informed. Stay disciplined. Stay grounded in fundamentals. And remember that true security comes not from picking the right asset at the right time, but from building a financial life that's resilient to many different outcomes.